Welcome to the club. My name is John. I will be your host for this Super Bowl weekend meeting. In this meeting, we are going to actually go ahead and invest in a mutual fund. It's going to be a category mutual fund. And once we get into it, I will explain my decisions on why I went with this and why I'm going with a Roth. So without any delay, I'm just going to go ahead and do a screen share. I think you'll find it pretty interesting, especially if you're new to investing and you're a do-it-yourselfer where you working with small dollar amounts. And I'll explain exactly how I go through this. Okay. Okay, folks. So we are back at the Fidelity account here. The first thing I want to talk about is the selection. As you remember, I've always been talking about the ticker symbol FIDSX, Fidelity Select Financials Portfolio. When we originally started talking about this, it was at $15.54. This is about 3 weeks ago. So within the first 5 weeks, it's up 6.17%. And if we take a look at this, we can see it's in the financial industry. The expense ratio is pretty low, 0.72. These are the companies that they have invested as top 10 holding, and it's telling you that this is a 40.29% weight of the entire investment. Matthew Reed is the manager over at Fidelity, and it's got some other categories. Now, this is one of the most inexpensive, but it's got all the big hitters in here, okay? So you can take a look at this on your own. If you look at this right here and you're talking with a financial planner, this is your hypothetical layout, okay? So what we're going to do is we're going to strip some of these away. We're going to take away this one, and we're going to take away the financials. So right here in the light blue, that's your S&P 500 index. That's not specifically financials. Take that away, and you can see that this is the track of the investments with a hypothetical $10,000. Now, when you're talking with your um, financial planners, what they're going to do is they're going to look at all your investments. And if you have an investment that's way down here where the cross arrow is, and the S&P 500 is way up there, they're going to see that your investments have a big gap in the growth. And they're going to recommend you get rid of that and get into something else. Okay. So we take away the S&P 500. Here's the financials. So the investment I'm about to pick is ahead, and we're going to add on this one right here. And you can see if I take away the financials, that is tracking with this MSC. These are like indexes, okay? But normally that's how you take a look, and you can look and see if your mutual funds are doing well. And when you're talking to a financial planner, because if they see that the investments are way down here where this cross arrow is, they're going to recommend you sell. And if they're investments you picked out, you may not want to do that. I ran to this in my times dealing with financial planners and just had to tell them, no, I'm not going to do it. It didn't go so well for me. I actually wound up getting rid of that person. The reason why is that the investments I had were really, really old and they paid a lot in capital gains. I mean, they were paying something ridiculous like 14, as much as possibly 19% in capital gains off of the $50,000. And that's a lot of money. Those capital gains, I stopped reinvesting them. They're going into a cash account. Okay. So over here, this is why we're going to go ahead and go and make a purchase now. So let's see if we can get back up in there. So here we come. Now you got to be very, very careful here. I want you to take a look at this. It's defaulting to a rollover IRA. This Fidelity account was opened up as a rollover. I um, I had some investments with a previous employer. They did really, really well, and I wanted to keep that money intact, not sell the shares and turn around and try and buy them because they were doing so well. So what I did was I rolled over into this Fidelity account. It's no longer an IRA. It is, I mean, a 401k. It's now an IRA. This cash available to trade is showing at $8,028. So remember that 8,028, because I'm going to tell you after we make the purchase how I have and why I have that in there. Okay. So we're going to drop down. The Roth IRA is here. Okay. Now, this is a Roth IRA. I've already met my 5 years on a previous Roth. You just make it on one. It's not the same as a 401k where you have a separate 5 year rule. I've already made this is the capital investment, $2,000, right? $15.83. So we're going to put in the $2,000. We're going to preview the order. Roth, I got it in a Roth IRA account portfolio, and I'm pulling it from the correct, and it's telling you the trade will be completed the next available price. The buy order you're about to place exceeds your settled cash, blah, blah, blah. Well, it says I got cash in there. So we're going to place the order. So the order is completed. When the market opens up, at the end of the day, there's going to be a settled cash amount. And then what we're going to do is we will have ownership of those shares in that investment. Now, I'm going to come out of the screen share and go back into the main screen and talk to you about this type of investment. Why am I doing it? And why did I pick that category? And then we're going to talk about that $8,028 that's sitting in the individual retirement account available for trading and what's going on with that. Okay. So just stand by and I'll be right. Okay, so we got our trade order placed. It will settle on Monday. So the market works a lot quicker now. It used to take 3 days for a trade like that to settle. So it should settle on Tuesday, where the transfer and ownership of shares will come to me. Now, here's the reason why I did financial services. Got a lot of people retiring real soon, and keeping your money in a 401k is not the world's best option. They have a lot of fees. You can't track any of the capital gains dividends that take place in those investments at all. They won't show up. As well as they are set up, if you take withdrawals out of them, they like to withhold 20% taxes. That's not good. So I have the Fidelity account set up. When I leave an employer, if I can, I'll roll over the investments, or I will sell the shares, roll it over in cash, and use the mutual fund finder like I just did with the financial services, and I will purchase and make new investments. The categories that I have to date are healthcare and natural resources, and then we just added the financial services. This is the newest one, as well as we have some international, and we've got about at least a dozen funds that are tied to the Magnificent Seven, which is basically the S&P 500. So that is how I'm diversifying. But the financial services has going to grow because of two things. Number one, you got a lot of people who are retiring and they're going to be moving their money out of these 401ks, opening up accounts. So there'll be more business. The other thing is that they're looking to possibly in the future get into crypto. So they'll be connected with some type of exchange and people will have their money. They'll be buying and selling of the cryptocurrency. That's the big movement going on now. When you go to the gas pump, you have a debit, credit card, and then eventually there'll be crypto. And that's what I feel is going to be happening. So now I'm getting in the financial industries as a category now with that $2,000. And that is just like me being a nobody investor. I'm making my own decisions. The ticker symbols, I keep talking about that over and over. I can now track that investment. The money I just purchased those shares with is called the cost basis. I always need to remember that and keep track of the transaction date, because when you start to sell, you're going to want to know that. And that money has already in a Roth IRA. I've met the 5-year rule, and the 5-year rule was started with a Red Oak Technologies investment 5 years ago. And that technology fund, I opened it with 5 grand, then I put 1,000 to 1,200 every year in it. And what happened was that investment had grew so much. The target amount was $20,000. Well, it's at about 19,000 right now after putting 5 grand in and just $1,000 per year. So you could see how starting an investment like this and putting $100 in it every month can potentially take you from having no money to being invested. And you work with this one category, and then you pick another one when you get more money, and you just start sending your money. And there's a lot of people doing gig work right now. If you're doing DoorDash, you're in construction, or you're a freelance person, and you're doing this, and you want to invest, and this is how you would do it. You send the money in when you can, or you can set it up to reoccurring deposits from your checking account. The money that I just spent on those shares came from my checking account. It took 3 days for that money to settle and it show up as cash to available to trade. So that's one of the biggest things about doing it yourself is getting your money together, making sound investments, and tracking them. So if this investment starts losing money and I don't like the way it turns out, I can wait until it gets back to my 2,000, sell the shares, and then pick something else. Now, the next thing I want to talk about is the rollover IRA that had $8,028. Well, have you ever seen the movie Casino where the guy goes into the money room? He's got one of those old school duffel bags and he starts putting money into his investment. A guy like that is going, what he's doing is he's skimming profits off of the money that's coming in. And that's exactly what I did. So by keeping track of those ticker symbols and watching them, when the market was booming, doing really, 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 really well, what I did was I got in and I looked at the performance history of 10 mutual funds in 2019. And out of those 10 funds, 8 of those funds, I skimmed $600. The funds themselves had tremendous growth, 500% over with only a couple $1,000s in it. So what I did was I went from having no cash to selling $600 in shares and then built that account up. And then I put it into, eventually I had it in a CD, which would make a little bit of money. And then in 2024, I had 3 investments that hit its all-time high. And these investments had large percentage of growth. So I skimmed $800 off of 3 investments. And that built up that $8,000 cash. Now that $8,000 cash is in a Fidelity money market growing at 4%. I could trade it or I can do whatever I want. But that is set up for me to have access to some cash. I will not have to pay the penalty on it, but I will have to pay the taxes. So when I go into retirement, I ain't got no job. Well, I could start withdrawing that money out. And if I only take out a certain amount, I won't pay any taxes because it will meet the standard deductions that the Internal Revenue Services allows us. It will be by the time I turn 65, my standard deduction will be 16,000. So meaning I could take that 8 grand out. I ain't got no job. My pension is $2,100 and my part-time gig is 2 grand. So I'm well below that. I won't pay any taxes on it. But that is how you can build up a cash in your portfolio. But you gotta keep track of these ticker symbols. You have to be engaged in watching your investments. When those investments start showing 600, 700% gains, you could leave them in there because they will do. You'll have a bad market and they'll fall back. Or you can skim, sell some of those shares and put it in the money market. And this year, when I took the $800 out of 3 mutual funds, the mutual funds kept going up. The price, the net asset value, which is what we saw here when it had a price of $15.84. And not only that, those investments paid capital gains at the end of December. So they continue to grow. But that's something that you have to track this stuff. That money right there is now part of the income bucket. It will just sit there until I need it. It's not a cash box where I'm taking money, paying my bills. It's just sitting there and it will continue to sit there. And I will continue to monitor these investments that are growing that I've had for a long time. They hit their all times high. We have a run on the stock market and I will go in and take some money out. First time I did 600, the second time I did 800. The other investments never did peak, so I just left them alone. But anyway, I wanted to share that with you on how you can start building up your cash reserves off of these investments, and have some money because if the market goes down like it did in 2022, it took a whole year, um, well, not a whole year. By June or July, we had gotten back to zero. All the gains had been recovered. We were back to zero, and then since then, it's been going up. And I expect this investment to go up. So this is it on the club meeting for today. I also have other videos queued up ready to go. So if you're enjoying this presentation, go ahead and join the channel. Be sure to like and you can leave some comments. And what we'll do is we'll continue working on this. Now, this is all coming from a do-it-yourself investor. I am not a financial advisor nor a CPA. This is all do-it-yourself stuff. And this is where you're going to get more information from people who are out here doing this versus reading a book. And if your account is really, really low where you can't get anyone to talk to you, you want to come to the Retiring Club. This is John, and this ends my presentation. And you enjoyed the Super Bowl, be sure to subscribe. I got a couple other videos already queued up to come out next week. And thanks for watching.